The article discusses the intersection of artificial intelligence, AI, and the energy sector, particularly focusing on the challenges of meeting AI's growing energy demands. AI's computational needs are rapidly increasing, necessitating a substantial power supply, which presents a significant challenge for utilities already facing rising costs. Concurrently, the oil and gas industry, having moved past the era of easily accessible reserves, is seeking new avenues for growth amidst geological constraints and economic pressures. This convergence of needs positions natural gas as a potential bridge solution, given its abundance and the existing infrastructure for delivery and integration. Key players such as Exxon and Chevron are expressing interest in powering data centers, highlighting a practical partnership between technology and energy sectors. While the shift towards renewable energy sources like nuclear and geothermal is gaining momentum, their immediate impact remains limited due to long rollout times. Natural gas, despite its controversies, offers a dispatchable and pragmatic solution to support the exponential growth of AI in the short to medium term. This evolving collaboration between energy and technology sectors underscores a structural shift where energy and computing are becoming interdependent pillars of modern innovation. However, this transition must be managed carefully to address consumer concerns over rising energy costs and potential resistance against unchecked technological expansion.
The U.S. Senate is engaged in intense deliberations over President Donald Trump's One Big Beautiful Bill Act, a comprehensive legislative package that proposes $4.5 trillion in tax cuts and $1.2 trillion in spending reductions. The bill seeks to make permanent the tax rates from Trump's 2017 reforms and introduce new tax breaks, such as eliminating taxes on tips and overtime. However, it also includes significant cuts to Medicaid and food stamps, with stricter work requirements, which the Congressional Budget Office estimates could increase the federal deficit by $3.3 trillion over the next decade and result in 11.8 million more uninsured Americans by 2034. The legislation also plans to allocate $350 billion to border and national security initiatives, partially funded by new fees on immigrants. The bill faces unanimous Democratic opposition, primarily due to concerns over healthcare cuts and the rollback of green energy tax credits, which could impact the renewable energy sector. Some Republicans, including Senators Susan Collins, Lisa Murkowski, and Tom Tillis, have expressed reservations, particularly regarding the effects on rural hospitals and Medicaid. Despite these internal GOP disagreements, the White House is pushing for party unity to meet a July 4th deadline, but the outcome remains uncertain due to procedural tactics employed by Democrats to delay the vote. In financial markets, U.S. stocks have reached record highs, with the S&P 500 and Nasdaq Composite buoyed by optimism over trade negotiations and expectations of deeper Federal Reserve interest rate cuts. This positive sentiment is further supported by Canada's decision to scrap its digital services tax, benefiting major tech companies. Meanwhile, the banking sector has seen share price increases following successful Federal Reserve stress tests, paving the way for stock buybacks and dividends. Home Depot is also expanding its supply chain capabilities with a $4.3 billion acquisition of GMS, reflecting a strategic shift towards professional builders as pandemic-induced sales decline.
Micron Technology Inc., Nasdaq, MU recently reported its Q3 results, showcasing a 5.9% increase in stock price since the last analysis. Despite concerns about an overextended valuation, the company is deemed fairly valued due to its strong position in the AI memory market, particularly with its high-bandwidth memory (HBM) products. These products are in high demand, positioning Micron as a key supplier in the industry. However, potential risks loom as the transition from AI capital expenditures to robotics demand might not be smooth, potentially affecting growth. The company's valuation suggests a bullish outlook, with expectations of a 25% return on MU stock over the next 12 months. This optimism is tempered by the potential cyclical risks associated with the evolving demand landscape. Investors are advised to monitor these developments closely, as the company's ability to navigate these challenges will be crucial in maintaining its growth trajectory. Despite these risks, Micron's prospects in the AI sector remain robust, making it a noteworthy entity for those seeking exposure to the technology and semiconductor markets.
GoviEx Uranium Inc., CVE has announced a significant development in Zambia's uranium sector. Highlighted in a recent Ellis report interview with CEO Daniel Major, the company has completed a $10.5 million private placement led by a strategic Zambian group, signaling robust insider support and cross-sector collaboration across agriculture, energy, and finance. This financial boost supports GoviEx's strategic expansion in Zambia, where the company is actively exploring the Muntanga project. The project is backed by a comprehensive feasibility study and has launched an exploration program targeting areas like Matango East and Kariba Valley. The Kariba Valley discovery, covering only a small fraction of GoviEx's licensed area, is already being heralded as a potential game changer for the uranium industry in southern Africa. This development comes at a time when global uranium demand is surging, driven by clean energy mandates and the expansion of nuclear power capabilities in countries like China, India, and the US. The uranium market is experiencing a supply crunch, with utilities understocked and geopolitical instability affecting procurement. GoviEx's strategic positioning as the only active uranium license holder in Zambia provides it with a unique advantage in meeting this demand. The company's focus on scaling up to a mid-tier producer status, coupled with its access to both Eastern and Western markets, positions it well to capitalize on the anticipated global restocking phase. This expansion could significantly impact GoviEx's growth trajectory and the broader uranium market dynamics.
Republic, a digital assets platform, is introducing mirror tokens that aim to offer retail investors exposure to private companies like SpaceX. Mirror tokens are digital representations that mimic the value of an underlying asset without holding the asset itself. Investors are required to lock up collateral, typically 150% of the asset's value, to mint these tokens. The concept has raised concerns due to its complexity and potential risks, especially since investors may not have a secured claim to the collateral. Republic's plan involves a special-purpose entity, RepublicX LLC, which offers unsecured debt rather than direct ownership or secured claims to SpaceX shares, raising questions about investor protection. The initiative highlights a broader issue: the difficulty retail investors face in accessing shares of high-demand private companies like SpaceX, which have not gone public. This demand has led to indirect ownership methods, such as special-purpose vehicles, which often come with premiums and additional risks. The situation echoes historical concerns from the 1980s, when the SEC encouraged Microsoft to go public to ensure investor protection and market transparency. As the demand for exposure to private tech giants grows, the lack of regulated pathways for retail investors could lead to potential scams and market instability, calling for regulatory attention and possible new frameworks to facilitate safer investment opportunities.
Nilesh Shah, a prominent financial strategist, highlights the current Goldilocks scenario in global markets, where central bank monetary policies have propelled asset classes such as gold, silver, and equities to all-time highs. This environment, characterized by low interest rates and ample liquidity, is fostering robust performance across diverse investment avenues. Shah advises investors to maintain a long-term perspective amidst geopolitical uncertainties, noting that Indian equities are particularly strong due to their resilience among emerging markets. He emphasizes that while short-term volatility is inevitable, long-term investors can expect steady earnings growth in the high single to low double digits over the next few years. Shah also identifies sectors poised for earnings surprises, including mid-cap IT, consumer durables, and discretionary segments. He cautions, however, that real estate, particularly in mid and lower segments, may face challenges, and sectors such as paints and commodities might underperform due to high base effects. Shah stresses the importance of strategic patience amid unpredictable policy actions from global leaders, advocating for investment decisions based on factual developments rather than speculative assumptions. Additionally, he sees significant investment opportunities in the specialty chemicals and pharmaceutical sectors, driven by easing Chinese competition and the essential role of Indian pharma in the U.S. market. These sectors are expected to benefit from improved capacity utilization and operating leverage, making them attractive for long-term accumulation.
Cathie Wood, the CEO of ARK Investment Management, has made a notable investment move by purchasing $20.7 million worth of shares in a tech company that has recently experienced a surge in its stock price. This decision aligns with Wood's investment strategy focused on companies that are considered disruptive and have significant potential for future growth. Her investment is driven by the company's increasing use of artificial intelligence (AI) tools, which are seen as pivotal in enhancing operational efficiency and driving growth. The investment highlights Wood's continued confidence in the tech sector, particularly in firms leveraging AI technology. This move is expected to influence market sentiment positively, as Wood's investment decisions are closely watched by other investors. The increased capital inflow into the tech sector could potentially lead to further appreciation in stock prices, benefiting investors with stakes in similar tech companies. This development underscores the growing importance of AI as a transformative force in the business landscape, with potential implications for various industries and market dynamics.
Rocket Lab USA, RKLB, is emerging as a notable player in the private space exploration sector, a field that is increasingly attracting Wall Street's attention, as the industry is projected to contribute an additional $1.8 trillion to the global economy. Rocket Lab offers an investment opportunity in a market largely dominated by private companies like SpaceX. Founded in 2006 and publicly listed via a SPAC merger in 2021, Rocket Lab provides rocket launch services and satellite-related hardware. Unlike SpaceX, which focuses on larger payloads, Rocket Lab's offerings, particularly its Neutron rocket, are designed for smaller payloads, catering to specific market needs such as national security and intelligence. Despite its rapid revenue growth, 32% year-over-year to $123 million in Q1 2025, Rocket Lab faces challenges, particularly in achieving profitability. The company reported a 37% increase in operating losses for the same period, reaching $59.2 million. This financial strain is compounded by a significant R&D budget necessary for the technical demands of the industry. With $303 million in cash reserves, Rocket Lab may need to seek additional capital, potentially through equity dilution, which could negatively impact stock prices. Looking ahead, Rocket Lab's future hinges on the successful launch and operation of its Neutron rocket by the second half of 2025, positioning it as a competitor to SpaceX's Falcon 9. However, investors might consider waiting for more concrete signs of progress before investing, as the company is still trailing behind its larger competitor in terms of market readiness and operational scale.
Stanley Black & Decker has announced a significant leadership transition, appointing Christopher Nelson as the new president and CEO, effective October 1, 2025. Nelson, who currently serves as Chief Operating Officer and Executive Vice President, will succeed Donald Allen Jr., who will transition to the role of Executive Chair of the Board. This change comes as part of a comprehensive succession planning process by the board, and marks a pivotal moment for the company as it continues its strategic transformation. Nelson's appointment is expected to bring continuity and a fresh perspective to Stanley Black & Decker's growth strategies. Leveraging his extensive experience in streamlining operations and optimizing the company's core businesses, the company remains optimistic about its financial performance, projecting second quarter earnings per share, EPS, to exceed its prior planning assumptions for 2025. This optimism reflects the successful execution of its transformation strategy, which has focused on simplifying operations and enhancing its portfolio of iconic brands such as DeWalt, Craftsman, and Black & Decker. The leadership transition is anticipated to further strengthen the company's position in the global market, driving sustainable long-term growth and value creation for stakeholders. As Stanley Black & Decker approaches the completion of its supply chain transformation, the leadership change is seen as a strategic move to capitalize on emerging opportunities and navigate future challenges.
MG Non-Life Insurance Company, a financially troubled insurer, may soon be back on the selling block following a tentative agreement between the company's labor union and the Financial Services Commission, FSC, the country's financial regulator. The FSC had previously decided to liquidate MG non-life insurance, transferring its policy contracts to 5 other non-life insurers through a bridge insurance company. This move comes after the insurer was designated as financially weak in April 2022, leading to 4 unsuccessful rounds of bids for its sale. Notably, Meritz Financial Group, once the preferred bidder, withdrew in March due to unresolved issues with the labor union over job security. The potential sale of MG non-life insurance is significant given its substantial portfolio, comprising 1.51 million policy contracts, primarily related to illness and damage, and serving approximately 1.24 million policyholders. The outcome of the sale process could impact market dynamics within the non-life insurance sector, particularly influencing the competitive landscape and possibly affecting policyholder confidence. Additionally, this development underscores the ongoing challenges faced by the company in stabilizing its operations and securing a viable buyer amidst regulatory and labor-related complexities.